The cost of generating electricity from solar has fallen by nearly 90% since 2010. Renewables are now the cheapest source of new power generation on Earth, yet your electricity bill keeps rising. That's not incompetence. Somewhere between the power station and your home, money is being extracted by people you've never heard of. And by the end of this video, you'll know exactly who they are, how they secured the right to collect, and why changing your energy supplier does nothing to remove them. Chapter 1. The Promise. By the 1980s, the electricity grid in most Western countries was in trouble. The infrastructure was aging, governments were broke, and nobody wanted to raise taxes to fix it. So they found another way. The argument went like this: private companies are more efficient than governments. They invest smarter, cut waste, and respond to incentives that public bodies never do. Hand the infrastructure to the private sector and everyone wins. Consumers get lower bills, governments get cash, investors get a return. It was a reasonable argument, and it found willing ears on both sides of the Atlantic. In 1989, Thatcher's government passed the Electricity Act, the law that dismantled England and Wales's publicly owned electricity system and prepared it for sale. The actual privatization followed in stages through 1990 and 1991. 12 regional electricity companies were created from the existing area boards and floated on the stock market. The Central Electricity Generating Board was broken up, its generation assets divided between National Power and PowerGen, its nuclear plants initially held back because no investor would accept the liabilities, and its transmission network handed to a new company called National Grid. 7 years later, California Governor Pete Wilson signed the state's electricity deregulation bill into law, describing it as a free market solution to spiraling energy costs. Within 4 years, California was experiencing rolling blackouts. Within 5, the experiment had collapsed. But that story came later. The pitch to voters on both sides of the Atlantic was simple. Competition drives down prices. Give private companies the incentive to compete and the consumer benefits. The problem was that electricity networks aren't like supermarkets. You can't choose a different set of wires. The infrastructure carrying power from the station to your home is a natural monopoly. One owner, one network, no way out. And competition cannot exist in a monopoly. The governments selling these assets knew that. So did the investors buying them. National Grid, formed directly from the privatization of Britain's own electricity infrastructure, crossed the Atlantic and quietly acquired the electricity networks of Massachusetts, Rhode Island, and New York, becoming the second largest utility in the United States. Berkshire Hathaway built a utility empire spanning 11 American states. These weren't companies betting on a competitive market. They were buying something far more valuable: a captive customer base, a regulated revenue stream, and a framework designed to make sure they always got paid. The promise was lower bills. What got built was something else entirely. Chapter 2. The Sale. The British government raised nearly £8 billion from the electricity sell-off. It looked like a good deal until the shares hit the stock market and immediately traded at substantial premiums, which meant the assets had been sold for less than they were worth. The opposition called it a wanton giveaway at the taxpayers' expense. They weren't wrong. What actually changed hands was extraordinary in scale. 12 regional electricity companies, the infrastructure keeping the lights on for every home and business in England and Wales, floated on the stock market in a single year, each now answerable to shareholders rather than the public. The government opened generation to competition. In theory, multiple companies could build power stations and sell electricity into the market. But the wires carrying that electricity to your home remained what they had always been. One owner, one network, no way out. And that owner, under the new regulatory framework, was entitled to a regulated return on every pound of infrastructure they owned. OFER, the Office of Electricity Regulation, was created to protect consumers from the monopoly the government had just built. In the first years after privatization, prices rose anyway. Profits rose. Executive pay rose. OFER eventually intervened, forcing price cuts that brought bills down through the mid-1990s. The government pointed to those cuts as proof the model worked. What it didn't mention was that the only thing standing between the consumer and the monopoly was a regulator, and regulators can be outmaneuvered in ways that markets cannot. In 2000, OFER merged with the gas regulator to become Ofgem. The monopoly remained. Across the Atlantic, the same logic arrived through different legislation but landed in the same place. Congress opened American wholesale electricity markets to competition in 1992. States followed: California, Pennsylvania, Illinois, Ohio. Texas went furthest, fully deregulating its retail electricity market in 2002, creating what its architects called the most competitive energy market in the developed world. In February 2021, a winter storm brought that market to its knees. 4 million Texas homes lost power. Wholesale electricity prices spiked to $9,000 per megawatt hour, the legal maximum, and stayed there for 4 days. Lisa Chumley, a second-grade teacher in Dallas, received an electricity bill of over $11,000 for less than a week of power. "I'm a teacher," she told the Texas Tribune. "I get paid once a month, and that's more than I see in 3 months. Normal people can't afford to pay that." A Wall Street Journal analysis found that over 20 years of deregulation, Texas customers had paid $28 billion more for electricity than they would have under a traditional regulated system. The investors who moved into these markets concentrated on the regulated part: the wires, the substations, the transmission lines, the infrastructure no competitive market could ever touch and no customer could ever choose to avoid. That was the asset. That was always the asset. The sale happened in boardrooms, parliamentary debates, and regulatory filings. Most people never noticed. They just kept paying their bills. Chapter 3. The mechanism. Most people assume their electricity bill is mostly paying for electricity. It isn't. Around a quarter of what you pay on your electricity bill goes to the companies that own the wires, and that proportion has been climbing for years. When Ofgem sets the revenue that network companies can collect, it calculates an allowed return on the infrastructure those companies own: the pylons, the substations, the cables buried under your street. The more infrastructure they own, the larger the return. The larger the return, the higher your bill. In theory, that's not unreasonable. Infrastructure costs money. Without a return, there's no investment. The model was designed to solve a real problem. The problem is what it created instead. The incentive for a private network company isn't to keep costs down. It's to own more, invest more, build more, because once Ofgem approves an investment, much of its cost is added to the regulated value of the network. Customers then repay that investment over time, together with an allowed financing return. The National Audit Office found that electricity network companies expected shareholder returns of around 9% in real terms during the first regulatory period, compared with an average of 5% to 6% for UK companies generally. Returns were higher than Ofgem had anticipated. Consumers paid the difference. In December 2025, Ofgem approved an initial £28 billion package across Britain's major electricity and gas networks for the 5 years beginning April 2026. Around £10.3 billion was allocated to electricity transmission alone, with the total program expected to grow towards £90 billion as further projects are approved. The investment goes in, the allowed return comes out, and the bill goes up. The cost of generating electricity from renewables has fallen dramatically in 15 years. Your bill hasn't fallen with it because generation is only part of what you pay. The network charge is the other part, and the network charge doesn't follow energy prices. It follows the asset base. That's the mechanism, and the system followed the incentive written into it. Chapter 4. The returns. In the winter of 2022 to 2023, a Which survey found that 13 million UK households had not turned their heating on despite the cold, choosing to sit in cold homes rather than face the bill. That same year, according to analysis by the Commonwealth think tank, the shareholders who own Britain's electricity and gas networks extracted £2.8 billion in dividends, roughly £100 from every household in the country. That £100 was no longer available inside the companies that collected it. It was distributed to their owners, while customers continued financing investment through future network charges. National Grid's electricity transmission business, which holds just £44 million of share capital, paid £300 million to its shareholders in a single year. The industry's defense is legitimate on its face. Private capital is funding the largest grid upgrade in British history. Tens of billions to connect renewables, electrify heating and transport, and meet rising demand. Without an allowed return, that money doesn't come. It's a real argument. But the investment numbers complicate it. Commonwealth calculated that energy investment averaged 1.15% of GDP during the public ownership period it studied, compared with 0.48% after privatization. The periods aren't directly identical. One included major post-war expansion, but the figures challenge the claim that private ownership automatically unlocked more investment. The energy network companies running Britain's infrastructure posted profit margins of 55% between 2020 and 2024, against a FTSE 100 average of 15%. Warren Buffett, whose Berkshire Hathaway owns utilities across 11 American states, has repeatedly praised the dependable economics of regulated utilities, where enormous capital spending earns regulator-approved returns over long periods with customers who cannot go elsewhere. The dream belonged to the investor. The cold home belonged to someone else. Chapter 5. The receipt. Here is what the promise actually cost. Since 2010, shareholders of Britain's privatised energy companies have extracted £70.7 billion in dividends, according to Commonwealth's analysis, not invested, taken out. That works out at roughly £250 per household per year, every year for 15 years, built into every bill, invisible to almost everyone paying it. In 2024, Commonwealth estimated that more than £400 of the average £1,719 household energy bill corresponded to pre-tax profits across generators, network operators, and suppliers. The profit was not the cost of the electricity itself. It was the return collected by the companies positioned between generation and the customer. Across the Atlantic, Berkshire Hathaway's utility division collected billions in profit across 11 states, while customers faced bills that consistently outpaced inflation across multiple regulatory periods. There is a counter-argument. The renewable transition is genuinely happening. Bills may eventually fall. In 30 years, the architects of privatization might be vindicated. But the 13 million households that chose to sit in the cold rather than turn their heating on in the winter of 2022 to 2023 weren't waiting 30 years. They were paying £250 a year to shareholders of infrastructure their government sold, in deals signed before most of them were born, under contracts none of them voted for. There is no obvious remedy. The contracts run for decades. The ownership is transnational and difficult for an ordinary customer to trace. A Canadian pension fund, an Australian infrastructure company, a Hong Kong billionaire, a firm in Sydney. You can vote out the government that signed the deal. Most of them are long gone. You can change the name on your energy bill. You cannot change the company that owns the only wires leading to your home. Complicit covers the systems most people pay into without understanding. If that matters to you, subscribe. The system is working, just not for you.